Welcome to Chapter 4, Comparing Mutual Funds. This sounds simple until two funds show up with similar names, different risks, different costs, and performance numbers that begin on conveniently selected dates. A useful comparison is not a horse race. It is a controlled test. We first define the investor's job, then make sure the funds own comparable exposures, use an appropriate benchmark, measure both return and risk, and finally ask whether the process and cost are likely to hold up. We will also deal with the active versus index question without turning it into a political identity. The goal is practical. By the end, you should be able to explain why one fund fits a portfolio better than another, even when a recent winner is not the better choice. Markets produce plenty of rankings. Investors need judgment. The modern comparison begins with humility. In 2025, 79% of active U.S. large cap funds trailed the S&P 500. Over the 15 years through 2025, the underperformance rate was nearly 90%. By May 2026, index products held 53.8% of combined long-term mutual fund and ETF assets. Those numbers create a serious burden of proof for active management, but they do not settle every investment decision. A fund can beat its benchmark and still fail the investor if it takes the wrong risk, distributes unwanted taxable gains, costs too much, or does not perform the job assigned to it. We saw a version of this after the 2020 growth and thematic boom. Some funds looked brilliant until rates rose and the market changed the exam. Comparing funds by last year's return is like choosing a winter coat based on yesterday's weather. Useful information, terrible process. This chapter builds 4 skills. First, match. Translate the investor's objective into the right fund universe, benchmark, and evaluation period. Second, measure, calculate cumulative and annualized return, then interpret performance after accounting for risk and the benchmark. Third, diagnose, separate what came from asset allocation, security selection, factor exposure, currency, cash, fees, and timing. Finally, decide. Choose active, index, or a blend based on evidence rather than slogans. Notice that only part of this work is arithmetic. The harder part is asking whether the numbers answer the right question. A perfectly calculated Sharpe ratio for the wrong peer group is still the wrong answer, just with more decimal places. By the end, you should be able to defend a recommendation in plain English and identify what additional evidence would change your mind. 4 connected questions organize the chapter. First, define the job. What outcome does the investor need? Over what horizon? In which tax setting? With what liquidity and loss capacity? Second, build the peer set. Are the funds actually comparable by category, strategy, wrapper, benchmark, and effective exposure? Third, measure outcomes. We will look at total return, annualized return, volatility, drawdown, tracking error, alpha, and information ratio. Fourth, interpret the process. Where did the return come from? Did it persist? What biases affect the record? And what survived after cost? The sequence matters. If we skip directly to performance, we risk answering the wrong question very efficiently. The goal is a mental model you can reuse whenever a fund company, data platform, or enthusiastic salesperson presents a league table with one fund highlighted in a very confident shade of green. Start with the investor's objective, not the fund category. The same fund can be sensible for one job and reckless for another. A volatile equity fund may be appropriate for a 30-year retirement horizon, but not for tuition due next year. Begin with purpose: growth, income preservation, diversification, liability matching, or a tactical exposure. Then consider horizon and risk capacity. Risk tolerance is how someone feels about loss. Risk capacity is whether the financial plan can survive it. Those are not the same thing, especially during a bear market when everyone discovers a new personality. Add liquidity needs, tax location, account access, minimums, platform restrictions, rebalancing and monitoring burden. Only then should we define the comparison universe. The fund has not changed when the investor's job changes, but the recommendation should. Fit comes before ranking. A category is a filing cabinet, a benchmark is a measuring stick. They can be related, but they are not interchangeable. A category groups funds by holdings, style, or mandate. A policy benchmark describes the market exposure the manager is expected to pursue. A performance benchmark evaluates return and risk, and sometimes a custom blend is needed for balanced global or multi-asset strategies. Peer medians provide context, but they are affected by fees, category rules, in which failed funds disappeared or merged. Some strategies also pursue an absolute objective, such as inflation plus a spread, cash plus a return target, or a liability. Benchmark shopping is one of finance's quieter magic tricks. A manager can look much better when measured against a conveniently weak opponent. A good benchmark is investable, measurable, appropriate, specified in advance, and consistent with the manager's opportunity set. You choose it before the game, not after checking the score. Return arithmetic changes the story because percentages do not cancel symmetrically. Total return includes price change plus reinvested income and distributions. Cumulative return tells us the gain or loss over the full period. Annualized return converts that result into a constant compound rate. Dollar-weighted return also reflects when the investor added or withdrew money. Consider the example on the slide. A 50% gain followed by a 50% loss does not bring $100 back to $100. It leaves $75, a 25% cumulative loss. The arithmetic average of the two annual returns is 0, but the investor's account strongly disagrees. This is volatility drag. Dollar-weighted results can be worse when investors add money after strong performance and sell after losses, which is the classic buy high, sell low strategy with excellent record keeping. Always ask which return is being reported, over what dates, and for whose experience. Risk is multi-dimensional. Volatility measures how widely periodic returns move around their average, but it treats pleasant surprises and painful surprises the same way. Drawdown measures the peak to trough loss, which is often much closer to the investor's lived experience. Beta measures sensitivity to a chosen market benchmark, so it is only as useful as the benchmark. Tracking error measures how much active return varies around that benchmark. Tail risk captures extreme or nonlinear losses that can hide in leverage, options, credit, or illiquid positions. Sequence risk matters when cash is entering or leaving the portfolio. A retiree does not experience risk as a standard deviation. The retiree experiences bills arriving while the account is down 25%. March 2020 also reminded investors that liquidity and correlations can change much faster than a monthly risk report. No single statistic owns the word risk. Use the lens that matches the investor's actual vulnerability. Risk-adjusted measures scale return by a selected concept of risk, and each one answers a different question. The Sharpe ratio asks how much excess return the portfolio earned per unit of total volatility. Alpha asks how much return remains unexplained by the benchmark or factor model. The information ratio divides active return by tracking error and focuses on benchmark relative efficiency. The Sortino ratio uses downside variability, which may better reflect the pain investors care about. None of these numbers is self-interpreting. Change the benchmark, risk-free rate, sample period, or return distribution, and the conclusion can change. A fund that sells volatility can report a smooth record for years and still hide a very ugly tail. A concentrated manager can have a low Sharpe ratio during a temporary drawdown and still possess a coherent long-term process. Ratios are lenses, not verdicts. Before admiring the number, inspect the assumptions that manufactured it. Performance attribution asks where the result came from. Start with policy, the strategic exposures the fund was authorized to hold. Then examine allocation. Did overweights and underweights across markets, sectors, countries, or odd duration add value? Next comes selection. Did the securities chosen within those exposures outperform? Interaction captures the combined effect of allocation and selection. Currency separates foreign exchange movements and hedging. Finally, subtract the implementation drag from fees, trading, taxes, cash, and timing. This matters because a manager may describe a year as excellent stock picking when most of the result came from an overweight to a winning factor or sector. During periods when a few megacap companies dominate an index, simply owning more of those names can look like genius until the regime changes. Attribution explains the past. It does not prove the source will persist, but it tells us which claim deserves further investigation. Persistence is hard to separate from luck, market regime, and survivorship. Evidence consistent with skill includes a clear process, results linked to the stated source of edge, reasonable behavior across different environments, team stability, and controls around capacity and implementation. Evidence consistent with luck or bias includes one short winning period, an unacknowledged sector or factor bet, a backfilled record, a peer group that quietly excludes closed funds, or a strategy that changes after every disappointment. Fund databases can become a little like family photo albums. The failed experiments are less likely to remain on display. Manager changes also matter. A 5-star history can outlive the team that earned it. The more flexible the explanation becomes after the fact, the weaker the evidence of skill. A good research process defines in advance what success should look like and what evidence would invalidate the thesis. The SPIVA record gives us a base rate. In 2025, 79% of active U.S. large cap funds underperformed the S&P 500. Over 15 years through 2025, the rate was 89.93%. These results are after fees, which is exactly where the shareholder lives. The conclusion is not that active management is impossible. The conclusion is that selection is difficult and the hurdle is high. An investor paying for active management needs evidence of a repeatable edge, a relevant benchmark, reasonable cost, stable people, and a portfolio role that cannot be obtained more reliably elsewhere. We should also acknowledge limitations. A scorecard summarizes categories and periods. It does not evaluate one specific manager's process or a future market regime. Still, ignoring the base rate is expensive optimism. Markets charge tuition whenever confidence outruns evidence, and they rarely offer financial aid. By May 2026, index mutual funds and ETFs held about $21.82 trillion compared with $18.75 trillion in active products. That gave index strategies 53.8% of combined long-term fund assets. This shift reflects lower fees, transparent exposure, tax efficiency in many products, easier portfolio construction, and investor frustration with persistent active underperformance. It does not mean active investing disappeared. In fact, every index reflects active design choices about eligibility, weighting, rebalancing, and what the benchmark excludes. Many portfolios now use a core and satellite structure. Low-cost index funds provide reliable beta, while selected active strategies pursue an edge in markets where information, liquidity, or capacity may create opportunity. Indexing won a great deal of market share by being boring on purpose. In long-term investing, boring can be a feature. The question is not which team you support, it is what each allocation is being paid to accomplish. Active and index are implementation choices, not investor identities. The index case includes low cost, transparent exposure, low manager selection risk, and reliable market beta. But indexes can become concentrated, use imperfect construction rules, or create predictable trading around rebalances. The active case includes the ability to avoid securities, concentrate conviction, hedge, hold cash, or exploit less efficient markets. But active funds add fees, manager risk, style drift, key person risk, and the possibility of paying a premium for benchmark-like results. Both approaches can be used badly. An investor can chase a narrow index after it becomes fashionable, just as easily as chasing a star manager after the best years are already in the brochure. Decide market by market and job by job. Use index exposure when reliable beta is the goal. Pay for active management only when the expected net value after all costs and risks is genuinely better. This case shows how a bad benchmark can manufacture apparent alpha. A global equity fund reports strong performance against the S&P 500, but the portfolio owns small cap stocks, emerging markets, and foreign currencies. The S&P 500 is familiar and liquid, but it is not the fund's opportunity set. First, rebuild the policy benchmark using a global investable index or a documented custom blend. Second, separate local security return from currency return and hedging. Third, compare volatility, drawdown, country concentration, and factor exposure. Then restate the claim. The manager may still have added value, but the amount and source could change materially. A global small cap rally or a weaker dollar can make the fund look brilliant against a domestic large cap benchmark without proving security selection skill. Benchmark convenience is not benchmark validity. The measuring stick should describe the race the manager actually ran, not the race that produces the nicest trophy. A disciplined comparison scorecard keeps the recommendation anchored to evidence. Start with fit. Does the fund perform the intended portfolio job? Then exposure. Are holdings, factors, duration, currency, and concentration truly comparable? Next, benchmark. Is the reference investable, relevant, and selected in advance? Review outcome through return, drawdown, and risk-adjusted measures. Examine process. Is the source of return understandable, repeatable, and aware of capacity? Finally, evaluate cost, including fees, taxes, trading friction, and the monitoring burden. This is not a points contest where 6 check marks automatically produce a winner. Some failures are disqualifying. A fund with the wrong exposure cannot be rescued by a strong information ratio. A brilliant process that costs more than its expected edge is still a poor bargain. The winner is the fund with the strongest evidence for the required job, not the fund with the most attractive fact sheet. Now apply the framework. A retirement committee is selecting a U.S. large cap option. Fund A is an index fund costing 0.03%. Fund B is active at 0.55% with moderate tracking error and a stable team. Fund C costs 0.90%, is concentrated, has strong 5-year returns, and changed its lead manager 1 year ago. The plan needs a core option that participants can hold without additional monitoring. Pause the video and work through 4 questions. What should a core option prioritize? What evidence would justify Fund B's additional cost? How should Fund C's concentration and manager change affect the decision? Would an index core plus a smaller active satellite improve the menu or simply add confusion? My provisional view is that Fund A has the strongest default case. Fund B needs process and net of fee evidence. Fund C may be a satellite at most because the record and the current decision maker are no longer the same thing. Pause the video and answer the 4 questions on the screen. First, what makes a benchmark appropriate? Second, why can an arithmetic average overstate compound growth? Third, what does tracking error measure? Fourth, what should we conclude from a high, long-term SPIVA underperformance rate? Once you have committed to an answer, here is the key. An appropriate benchmark matches the fund's mandate, investable opportunity set, risk, and currency. Arithmetic averages can overstate growth because volatility reduces compounded wealth. Tracking error measures the variability of active return relative to the benchmark. And the SPIVA evidence establishes a difficult base rate and a high burden of proof. It does not prove that no active manager can add value, and it certainly does not make an index fund risk-free. The purpose of the check is not to reward memorization. It is to see whether the comparison logic is becoming automatic. Carry 6 claims into the next chapter. First, define the job. The investor's objective determines the relevant universe, benchmark, horizon, and risk. Second, match exposure. A comparison is invalid when holdings, factors, currency, or duration differ materially. Third, use multiple risk lenses because volatility, drawdown, tracking error, tails, and sequence risk answer different questions. Fourth, use attribution to connect return with allocation, selection, factors, currency, cash, and cost. Fifth, respect the base rate. Most active funds underperform over long periods, so evidence of edge must be unusually strong. Sixth, active and index can coexist when each has a clear portfolio role. A benchmark should be a measuring stick, not a conveniently weak opponent. In Chapter 5, we will add the next discipline, quantifying every layer of cost and seeing how small annual differences compound into very large dollar differences. This final slide is the source register for Chapter 4. Posen and Hamacher provide the conceptual structure. The SPIVA scorecard supplies the active management base rate evidence. Investment Company Institute data tracks the shift between active and index products. SEC CFA Institute and FINRA resources support performance, standards, and fund comparison tools. There is no need to read every web address aloud. The important habit is to distinguish primary evidence from commentary and to check the date before reusing a statistic. Market shares, scorecards, products, and regulations change. The comparison discipline should not. With the framework in place, the next module is Chapter 5, the cost of fund ownership, where the market's least exciting numbers become some of the most financially important.